All right, well, formally, good afternoon, everyone. My name is Keaton Make with Asset Strategy Consultants. I'm very excited to be working with Jim Dowling this afternoon on our Q4 educational webinar, which we're going to go over plan sponsor attitudes and themes for 2023. I'm a financial advisor and plan fiduciary, work for Asset Strategy Consultants. Asset Strategy Consultants for 3 decades has been offering independent investment advice to foundations, endowments, nonprofits. We've done a lot of work in the 401k space, and we've also built out a nice private wealth sleeve of our practice. I'm very excited to be working with Jim Dowling, who's a senior vice president at Fidelity. Jim and I have worked together for a while, and frankly, at Asset Strategy Consultants, we try to be proactive about what's going on in the retirement plan space. I do a lot of these presentations. I would say this is probably going to be one of the most worthwhile conversations that we have. The last few years have been very bizarre for a few reasons. And one of the pretty interesting things that Fidelity has done is a really nice survey of plan sponsors all across the country. And what we're going to do is we're going to talk roughly about 6 or 7 key areas about what plan sponsors are seeing, how they're implementing and kind of changing their plans over time. So with that, Jim, I'll give you a chance to introduce yourself and we can dive right into key themes.
Great. Thanks so much. I appreciate the partnership with Asset Strategy and you putting this together. I appreciate everybody's time today. I think it'll be a worthwhile meeting to share some data and some ideas. I've been with Fidelity Investments now for 22 years, and I work with our retirement plan consultants like Asset Strategy and their plan sponsors, really trying to share some of Fidelity's perspectives. I think one of the advantages we do have is we do have a large book of retirement clients. I think we're the largest retirement 401k provider in the marketplace, number 2 provider of target date strategies. So what we try to do for you all is really bring that real-time data to share with you. What are your other peers at other companies thinking about? What are the impending trends? The framework we'll use today is our annual plan sponsor survey. This is something I've been working on with our team since 2008. So this is something we do on an annual basis. We go to market and actually use an independent third-party consulting firm. And they interview last year over 1,200 folks like you, trustees, decision makers on retirement plans. We think it gives us a pretty big sample size of real-time data of what's going on in the marketplace, what's top of mind for folks like yourself, and what are impending trends. Every year there seems to be an emerging trend. I think the emerging trend, if I was to summarize it, and we're going to click down into a lot of these things, is really heightened plan sponsor activity and engagement. I think if you think about, as Keaton put it, the strange last few years that we've been in, for you folks working in an HR functionality or an administrative functionality around the plan, it's been a really challenging couple of years, and a lot of stuff has maybe taken a lot of your time and energy away. What we're hearing from folks like yourself is there's a renewed emphasis to look at benefits, and specifically retirement benefits, and say making sure you have the right folks in place. As you'll see here, there's a lot of engagement, and we think there's folks are going to make some changes that have maybe been shelved for the past couple of years. So with that, let's kind of transition to the first theme that we're seeing out there in regards to retirement plans.
Sure. So maybe I'll just preface it with this. I mean, there's a lot of things we could talk about and cover in this presentation. I know that you work closely with plan sponsors like we do. Can you just talk about maybe some of the key themes that we're seeing? And I'll preface it with this. A lot of the, I'd say, prospects, at least, that I've talked to at conferences or kind of just out in the world, really haven't modified their plan design. You should look at it every year, but they really haven't modified it since before COVID. And you kind of think about, at least in Pennsylvania, where I'm giving this presentation today, shutdowns in Pennsylvania really started in March of 2020. So you start talking about kind of running with the same plan for 2.5 years. You think about what's changed in 2.5 years, and the answer is almost everything, right?
Yeah.
So Jim, if you could kind of just go over maybe some key themes that you're seeing, we'll start there and move
Yeah,
forward.
100%. I'd say the big theme to your point is the world has changed, and we haven't probably kept up from a benefit strategy, and we're kind of dealing with stuff pre-March of 2020 from that standpoint. So a couple big themes that we're seeing emerging. We're seeing probably from a provider standpoint, one of the biggest potential shifts that we've seen in a long period of time. And what I mean by that is a lot of decision makers at these companies have delayed switching or doing a record keeper search, so a service provider search that standpoint. So we're seeing all-time highs from a record keeper search standpoint. The other big thing we're seeing is a consultant fiduciary search as well. A lot of this stuff had been put off for the last couple of years, and I think what happened was there may have been some servicing issues as the world quickly pivoted from an in-person reality to a digital form of service from your service providers. And I'd say if there were servicing issues pre-March of 2020, those cracks in the relationship were probably exacerbated from that standpoint. Second thing that we saw happen, which we'll get into in a little bit more detail, and we really want to kind of dive into this is people have changed and people's perceptions have changed. And how does that relate from a benefit standpoint? And what do you do as someone who's kind of working closely in your company and providing benefits? How do you look at that? So a lot of companies are taking a refresh look from that standpoint. People have gotten older over the last couple of years, which we'll get into in a second. What are the potential impacts that we've seen from an organizational standpoint there as well? And then a look maybe more holistically at a lot of the other benefits out there in the marketplace. That could be HSA benefits. It could be something we'll talk a little bit more about, financial wellness. So those things from a benefit standpoint and the integration of the retirement plan with maybe some broader benefits on the insurance side and the wellness standpoint from that standpoint. And maybe we'll get a chance in a couple minutes to touch it on the end. This concept of ESG or environmental or impact investing or sustainable investing has certainly percolated up, and we're talking a lot more about that. And I'll say certainly Keaton will have a copy of the longer presentation, certainly can share with you most of that sort of stuff. But I think it is a lot of engagement. The world has changed dramatically over the past couple of years. Folks like yourself have been very busy. And now I think there's a renewed focus of looking at the holistic benefits, looking at the retirement plan and saying, okay, what thoughtful changes do we maybe want to make to match the benefits versus the new norm and the new reality, which we're in right now?
I think that's right on, Jim. Actually, a lot of the work that we've been doing over the past 2.5 years has been quarterbacking RFPs and RFI. So as a real kind of takeaway, the record keeper hasn't been looked at, costs haven't really been analyzed, and everyone's struggling to try to understand how to recruit and retain top talent. That means your benefit package needs to be top tier. And if it hasn't been looked at, well, asset strategy consultants can really help run that project for you. I was just at an HR conference yesterday in Baltimore, and just talking with all the HR professionals there, they have so many issues that they're dealing with right now. It's always been the case, right? But all up now, it's their workload's unbelievable. So if we can offload some of that work and kind of be the person to delegate those responsibilities, we're happy to quarterback that process for you. And again, the whole goal is to really attract and retain top talent. Jim, I know this is one of your slides here, but if you just want to go into what the labor market's doing and what the situation here at 2022 is.
Yeah, let me, this is pretty interesting statistics, and I'm gonna kind of think about the theme that we're talking about is the world is certainly a little different than it was 2.5 years ago. So what we asked, and this is there a gap in what your employees are looking for and what you're viewing as benefits? And I'll get into this in a second and a little bit more. Basically, we asked folks like yourself, plan sponsors, benefits folks, what are the most important, what do you perceive as the top valued benefits out there? And as you can see here, the 401k plan, health insurance was kind of top of the mark, I think, through education and people being aware of how important it is to save for retirement. The 401k plan has kind of moved to the top, again, from decision makers like yourself, kind of thinking about what's most important. Obviously, the healthcare plan and insurance is there as well. As you'd imagine, paid time off, flexible work conditions, the benefits that you're offering there. What's interesting, though, is if we overlay this with what we're hearing from employees, we're hearing a little bit different of a response. And what we're hearing there is, in addition to this stuff, this is almost like table stakes now. And I think as Keaton alluded to, it's an extremely tight labor market. It's a maniacal fight for talent. If you lose someone making $50,000 or $60,000 a year, when I talk to headhunters, it'd say, gosh, think about replacing that person for $70,000 or $80,000. It's a real maniacal fight for talent from that standpoint as well. So I think you want to kind of limit the gap of what you view as important, but also what employees view as important. And the key things that popped out to us, again, talking to employees and saying, what are the benefits that they most value right now? The biggest things we heard from them, in addition to retirement, which is always important, was professional development, opportunities for professional development inside the organization. Surprise, surprise, continued remote work. I've been at Fidelity for 22 years, and I think upper management would love to have everybody back in the office 5 days a week. But I've never experienced a position where labor versus management has enough negotiating and has the negotiating power. So remote work is something that's very valued right now when we talk to employees and thousands of employees. Flex time at work, paid vacation, and compressed work weeks from that standpoint. So I just bring those things up, and we can share more data with you, and Keaton can share more data with you. It's just kind of understanding and saying what's most valued by employees right now, and does it look a little bit different than the traditional benefits as well? And there are certain ways, are there ways for you to flex a little bit from the benefit standpoint? I'd say the big picture standpoint, and what's driving a lot of this is we're seeing a transition from a live to work, meaning kind of my mindset, that's how I identify and how I do it, post-COVID, to a work to live. And the numbers are pretty staggering of what we're hearing from employees across a variety of industries and a variety of geographies. Roughly 72%, or I should say 72% of respondents, these are the employees, said they have a different look at a work-life balance post-COVID, right? So their view of the world has changed. Maybe it reverts back. But I think it was an unbelievable experience all of us went through from that standpoint. Close to the number, 65% have said their priorities have changed. And lastly, 60% said they've had more of a focus on their own mental health from that standpoint. And I do think from a benefit standpoint, it's just something to be aware of, and to kind of put the bookend on this. It is a very tight labor market. You just want to be extremely thoughtful of like, what are the benefits that we're offering, and are our benefits aligning with what employees are valuing most right now? And it could be a little bit different than what it was 2.5 years ago.
Yeah, that's spot on, Jim. One of the things that we're seeing is when we talk to prospects at asset strategy consultants, a lot of plan sponsors or investment committees or directors of HR, they don't necessarily know what resources are available to them. So they hear kind of the employee whisper and the chatter, and it kind of gets shuffled under, or swept under the rug, so to speak. So I would just put this point out here is that you need an ally as part of this process to better understand what options are available to you, or what options are on the table when it comes to benefits, particularly in the, I'd say in the HSA and the 401k and the retirement plan space and the financial wellness space. Most people don't know the right questions to ask. So I would say that you need an ally in that space, and we can happily be that ally for you. So we'll shift. Jim, you have anything else here on?
Yeah, no, on that comment, which is great. And it's got the stat here. I think the when you're sitting in your organization and you're in your silo and you're sitting in meetings with folks in your organization, I do think it's important to kind of look at data like this and also work with an advisor, someone who kind of has a purview of more broadly what's going on. And we've certainly seen that trend, and you can see it here. It's, 91% of folks here are kind of relying on, folks like yourself and asset strategy to do the due diligence and provide kind of best thought leadership and what you're seeing across an industry. And obviously you folks are tapping into providers like myself and all the other great providers out there to get these big picture data of what's going on and what are the best practices.
Yeah, we've really refined what our role is over the past few years, and we've kind of boiled it down to just being an ally or being helpful in a strategy. It's running a business is very complex. Running an entire benefits program is complex. Dealing with tens or hundreds of employees is a complex thing to do day in and day out. So if we can be part of your team or a resource, even to lean on us for ideas, that's kind of our emerging role over the past few years. So let's change gears a little bit and talk about some of the top goals and concerns that we're seeing. So again, this is really focused, just similar to our last slide, focused on attracting and retaining top talent. So Jim, do you want to talk
Yeah.
about some of the top goals and then, alternatively
Yeah.
some of the concerns?
Yeah, I view this again, interview 1,200 trustees on plans, decision makers, plan sponsors. And the left-hand side of this is like, what is my aspirational goals? What do I want to achieve? And I view it as the right-hand side is what keeps me up at night? When I wake up at 3 or 4 in the morning, what am I worried about from my employee standpoint? And this kind of gives you an idea of your peers out there. What are the goals of the plan? And there's some evergreen themes that kind of fall on both sides of the ledger board. The one is we want to make sure our participants are saving enough through their working years, right? Are they saving enough for retirement? And we'll dig a little bit deeper into this. I think there's a little gap, again, between perception versus reality of what folks need to be saving for retirement and retirement replacement ratios. Again, kind of highlighting the need to kind of lean on some expertise to make sure that folks are saving. Well, it's like, Sue has an account balance of XYZ, but well, they're making this. So really kind of understanding that folks are on the right track for retirement. And we'll get into it that we're in a much better position than we were 5 years ago, 10 years ago, 15 years ago. But that's kind of one of the aspirational goals. And the second one kind of bookends that as well is adequate retirement savings to replace income for working years. That's the kind of the mathematical challenge, the financial planning equation right here. And it's a really tough one, right? And all of us who work in this business, it's a very challenging thing. What we're asking human beings to do is to basically defer gratification. And what I mean by that is take money that they could go out and spend and enjoy through experiences or products and put that into this thing called a 401k plan that they can't see, they can't touch, they can't feel for a payout 20 years, 25 years, 30 years down the road. And as a human being, that's a very challenging thing to do. But the name of the game, if you think of the equation, the challenge for the equation is you're talking about a retirement in years that can be almost as long as your working years. So every year that you're working and you're saving for retirement, you're trying to put enough money away and hopefully have growth so that you can replace your income in your retirement years. And hence, that's why sticking money in money markets and stuff, you need the growth, but you also need a pretty high savings rate because I can't underestimate and I can't over kind of explain how important and how challenging this equation is. And again, teaming with the right folks and working with the right folks to get folks encouraged to do that challenging thing, which is not spend on the visceral experience right now to put it away for retirement. The third thing here, which is really popped up recently over the past couple of years, this unbelievably historically tight labor market right now has just been a really tough fight for talent. So what we're hearing, and a 9-point increase over last year, believe it or not, which was a very tight labor market as well. We want to make sure we have the benefits in the retirement plans that will attract and retain and remain competitive in our marketplace. Again, losing an employee is extremely challenging. And it's expensive to rehire. 66% of our plan sponsors said they have hired a worker in the past year, which they never would have hired previous to that. Meaning because the labor market is so tight, they're kind of going down the spectrum of the quality of worker, which they're looking to employ. And then lastly, savings opportunities for retirement. So those are the kind of the aspirational goals. Keaton, I don't know if you kind of see you're hearing anything else from your clients out there of what they're trying to accomplish.
Yeah, here's what I'll say on this. I talk to a lot of plan sponsors every year. And in addition to that, I probably talk to 11, 12, 1,300 employees, plan participants. I talk to everyone. And one of the interesting things that I'm hearing on the plan participant side is they don't understand what benefits are available. And I'll be very specific. There's been multiple times this year where we've won new business and employees don't know that there's a match, or they don't understand the match, or they don't understand what particular benefits are in the plan. So I think the top concerns about the plan, this is a really good slide. I would just add a footnote and say there has to be some type, other than just the notices that you're required to send out to plan participants when they're eligible to the plan, and then every year. There has to be some type of marketing. There has to be some type of education. There needs to be some communication to employees on a regular basis, particularly for newly enrolled employees, right? Or new hires. So a lot of I'm not saying all the concerns about the plan can be alleviated, but I'm just very surprised when I talk to plan participants. They don't understand the matching formula. They don't understand eligibility requirements. They don't understand there's a loan provision in the plan. They don't understand a hardship withdrawal and what that actually means. So there's a lot of opportunity for marketing or communication internally to employees of what the benefits actually are. So I thought I'd just include that there.
Yeah, I'd say that's a really good point, and I'll take it personally from my own perspective of working for a company that, you know, has tens of thousands of corporate clients in the benefit space. When I'm going through annual enrollment on an annual basis, and I don't think it has to be as formal as this, but my company, Fidelity, kind of puts it in my face. Okay, Jim, you know, you may think that this is what you're getting from us, but by the way, here's what we're spending on you with healthcare dollars. Here's what you have an ability for from match dollars. Here's ancillary benefits, almost a Denny's menu to remind me. And at the end of it, you're like, wow, this company is really doing a lot for me. So maybe I'll be a little, you know, maybe I won't take that headhunter call or whatever the case may be. I think it's very important because you're spending the money as an organization. You want to make sure you're getting the credit for those benefits dollars that you're spending. And I think, you know, helping to figure out a good way to keep it in front of people so they realize so you're getting the goodwill from all those dollars that you're spending, I think is a really crucial point, and something that as I go through my benefits period right now, it's something that's certainly been top of mind from that standpoint. What keeps folks up at night? It's kind of the flip side, but a different view of this. So we want to make sure our employees are saving enough for retirement. And this is a really interesting point. You've got an aging workforce right now in the United States, and it's a double-edged sword right now. And what's going on and what a lot of companies are thinking about is the average worker at Fidelity has gotten older year after year. The challenge, especially for the baby boomer cohort, and we're kind of getting towards the tail end of that, is this is a cohort, and especially older workers, think about them for a second. They started their working career probably with some sort of DB or a pension plan, guaranteed plan. Originally, these 401k plans were the icing on the cake. We would have a pension plan, and this was an ancillary savings plan. The icing on the cake over time has become the cake, the entree, the appetizer, basically the entire meal for our retirement savings. So there are folks who are concerned is like, do people know how much they should be saving? And we'll get into some of the statistics as well. So what keeps folks up at night is, oh my Lord, maybe my employees will never be able to retire. And what is that going to do from a benefits cost standpoint, from a worker mobility standpoint? And what I mean by that is taking younger workers who want to have more responsibility and move up the management chain, become frontline managers if people never leave. And then even, you know, from an efficiency standpoint, from a productivity standpoint. So definitely, like, the intersection of the retirement plan is like, it's not a silver bullet where you can flip it and have everybody retire who's 58 years old, who's undersaved, but having the right structure in place, working with the right advisor who has it set up so that people are on the right path to retirement so they can retire when they want to retire. And what you don't want is you don't want to have that employee who's already quit and doesn't care, but they have to be there. And that is a toxic situation.
Yeah.
Yep.
Oh, gotcha.
No, all you.
I was going to say that is a toxic situation. Essentially what's happening, if you kind of look at the demographics of the United States, you brought up the baby boomers. There's essentially 60 million baby boomers, and they're transitioning out of the workforce. And the limelight's kind of been on this, on the millennial generations. You have roughly 90 million replacing 60 million baby boomers. And one of the things that we included in this presentation today is just a little bit about, you've probably heard in the news, this great resignation. You might be experiencing it yourselves in your organizations. But we wanted to try to touch on the great resignation and what that actually means in real terms, talking about particularly the baby boomer generation retiring early. We've certainly seen that at Asset Strategy Consultants. A lot of conversations around, do I leave? Do I kind of initiate retirement? What does that look like? Talk to me about drawdown risk. Do I have enough money? We'll talk about retirement readiness in a second, but I always think about, as a story, I always think about my dad's mom, my paternal grandmother, who is 93 years old. So you think about wanting to retire, kind of that full retirement age, depending on when you were born, 66, 67 years old. Well, if you retire at 67, and you live another, 2 or 3 decades, there's a lot of planning that needs to be part of your strategy for the long term. So when it comes to the great resignation, there needs to be a lot of tailored conversation to plan participants about what that actually means. So Jim, if you want to just take a look at the slide, we can kind of talk about that in real terms.
Yeah, I'm gonna break this down too and do it generationally as well. I think we call it the Great Resignation, but I also think there's an element, which I'll get to in a second, that I'm gonna call the reshuffling, which is probably more apt for younger workers, which is what you're all dealing with from an organizational standpoint as well. So the Great Resignation, or resigners, if you will, it's a mix. I was talking earlier about these organizations saying, "Holy cow, no one's going to be able to retire. It's going to crush us from that standpoint." Well, we've seen in the past 2 years is not a total reversal, but a lot of these organizations of saying, "Oh my gosh, I thought Jim or I thought Sue were going to be there for another 3 or 4 years. They're retiring. I've got a knowledge gap." It's kind of a brain drain from that standpoint, from an organizational standpoint, from an interpersonal standpoint, employee standpoint. You want to make sure these folks have enough money to retire and they understand how much money they can draw down from that standpoint. It's pretty crazy. COVID was definitely an accelerant for retirement for a lot of folks. And I think there were a couple things driving that. One thing was people said nothing is guaranteed in life, and I'm going to enjoy the rest of my life. I was stuck in my house for quite some time, and now I'm going to go enjoy life. So there's that element. The other element that we have to be aware of was an economic element, in that the market over the past 3 years, net of this year, did around 25% per year. So if I thought it was going to take me another 5 years to get to the end goal, it took me 3 years now. And we know this year the Lord giveth and the Lord sometimes taketh away. But there was the economic element from that standpoint. But I think what we're seeing too is due to reasons within their control. That's not somebody hitting the lottery as well. That's, you have a health, you need to care for a loved one or something like that. So there's a big element from that standpoint. If we go demographically too, and we start to look at it, female participation in the workforce, or the resignation of females, was really staggering when we look at the Bureau of Labor Statistics from that standpoint. We saw a lot more women leave the workforce through COVID, and many of them have not returned to the workforce. And if you think about that, oftentimes women may be the primary caregiver in a home, specifically for the children, and just unbelievable amount was kind of thrust upon them, homeschooling and that sort of stuff, and all that sort of stuff. So it was an unbelievable thing that we kind of observed. So we definitely saw demographics from a lot more females from that standpoint as well. And then unfortunately, mothers with lower education or levels of salary as well, folks who probably had less access to paid leave or ability to do remote work or affordable childcare. We saw a lot of those folks leave the workforce as well. And we also saw a big shift from the traditional workforce more to the non-traditional workforce, or what we're calling the gig economy from that standpoint. So kind of a big transition, this Great Resignation. To take it one click down, though, I'm going to kind of talk about another group called the reshufflers. And this is more the Gen Z, maybe millennials as well. And what they've been doing is really capitalizing on a very hot job market. And maybe you've seen this in some of your organizations as well. Half of the folks surveyed from this demographic considered changing jobs in the past year. So think about that. Half of the people under 35 years of age have strongly considered leaving their job, and a third of them have taken a new job. So pretty unbelievable turnover. We'll see if the Fed does its job, which is trying to cool a very hot labor market right now. And this may all change, and we may be talking about something else when I'm hopefully invited back to speak with you all next year. What we also saw is we saw a lot of industries that really struggled as well. And it was mostly in frontline roles, a lot of reshuffling in frontline roles. Now, what does that mean? That's retail, that's hospitality, that's customer service, that's healthcare. These jobs are about 80% of the American workforce. And a lot of these jobs were physically demanding, less flexible, less benefit standpoint. So we saw a lot of frontline working shuffling as well. And we've all seen this probably, even if we don't work in that space, going to a store, going to a restaurant, these sectors are struggling for workers. The other reshuffling we saw was highly skilled workers and knowledge-based workers. So think about folks who can work remotely. So we've seen a lot of change from that standpoint as well. I don't have the crystal ball. I don't know what the next 2 years looks like. Certainly no one does. But certainly there's been a really big change from that standpoint, and something you want to think about from an organizational standpoint. And I'm sure a lot of you have seen as well, not just that Great Resignation, but also a lot of movement from the reshuffling, and potentially for you and as an organization, maybe a chance to attract new talent.
I love doing these with you. Every time I do these with you, I learn something new, Jim. That's good.
Yeah.
I do want to shuffle over to employee retirement readiness, because I think this is kind of the key one of the key issues that we've at least been kind of beating the drum on at Asset Strategy Consultants. I just said a second ago, I talk to hundreds and hundreds of plan participants every single year. I would argue that this is probably the most important thing that I think about when it comes to actually helping people and educating people, making sure that your workforce is ready for retirement. Jim, you just mentioned a second ago some of the toxic backlash you would get when a more seasoned employee doesn't retire on time. You talked about a knowledge gap. There are a lot of internal issues that can arise, and a lot of mental health issues that can arise if your organization isn't having a strong succession plan, and there's not a good way to get employees to retire when they're ready to retire. And that whole conversation evolves around, do they know how to get ready for retirement? Do they understand that process? Do they understand what they need? So I'd like to at least talk about what the plan sponsor perception is regarding retirement readiness, and just to talk about some of those strategies.
Yeah, this is prime example. 2019, 2020 doesn't seem that long ago, and this is are your employees saving enough for retirement? And the number has crept up to 2022, and we did this kind of before the market downturn. I think it was market forces that kind of drove this number up. What's interesting when you unpack these numbers, perception versus reality, we break down this survey between CEOs, business owners, finance, treasurer, controller kind of bucket and segment, and then also HR. When we talk to CEOs and business owners and say, are your employees saving enough for retirement? There is an unbelievable confidence that they are. We're spending X amount of money on match dollars. They darn well better be saving enough for retirement. When we move to the HR functionality, that number creeps down dramatically, well into the 50s percentile, because they're frontline and they're seeing what's going on from a hardship withdrawal and that sort of stuff. My own personal opinion is I think this number is artificially inflated. I don't think people are probably saving enough for retirement. The number that Fidelity puts out there is a total savings rate of 15%. That's employee and employer match. That is, I'm not going to get into the weeds, but that's running the numbers on a good market, an average market, and a poor market, giving somebody a high probability of replacement income. The target that we want people to shoot for from a replacement ratio is about 85%. 50% coming from your retirement plan and about 25% from Social Security and outside savings. Mm-hmm. And honestly, that's about 100%, because when you're in a retirement, you're not saving for retirement. So you can kind of take that out of the equation. And the reason we talk really quickly on 100%, you want to think in retirement, you're almost going to need to replace 100% of your income. And the reason being, early on, you have a lot of free time. And I always ask the question to audiences, do you spend more money on a Monday or a Saturday? Right. Saturday, I go out to dinner, got a babysitter, do this, go out to lunch, blah, blah, blah. Monday, I'm working and busy. And retirement in the early years is 7 Saturdays. And a lot of free time to spend money. You're spending, what we've seen slows down as you enter your mid to late 70s. You travel less, do less stuff. And then if you're living to your 80s, it kind of picks up from a healthcare expense. So that equation is very challenging. And I would say these numbers are a little bit high, and 15% is kind of that benchmark number from that standpoint. The right-hand side, very quickly, if you have auto enrollment at 3% and a match at 3%, so someone's saving 3% and then they're getting a match at 3%, that 6% is a far cry from 15%. And I would put forth that you're probably setting people up for disaster. I understand it's a little bit challenging to do auto enrollment, or maybe you're nervous and that sort of stuff. But again, if you set them at a 3% with a 3% match, they're thinking that 6% is where they should be, and they're probably not going to move that with an auto increase.
Yeah, talking to these plan participants, I would make the argument that it's not a concern for younger participants. And then there's this light switch, or this light that comes on, I'd say mid to late 50s. I'd probably say mid 50s. And a plan participant all of a sudden is hyper overly concerned about their balance in their 401k or their 403b. It's like a complete transition regarding I don't really care about how much I'm contributing to, what's the most I can contribute, and how much money do I need for retirement, and how am I doing compared to my peers. And it really goes to the taking the role of a teacher and educator in our role as the advisor, and getting with plan participants early to making sure that they're ready for retirement. A lot of people particularly in their 20s, but I'd say even 20s and 30s, are tired of us kind of beating that drum, saying to Jim's point, hey, you'd want to consider putting away 15%. Their employer gives them 4%, they're doing the match, and they're not really worried about that. And then 1 decade, 2 decades later, all of a sudden they're playing the catch-up game because they weren't having these conversations, these tough kind of delaying gratitude or delaying pleasure conversations early on in their career. So to Jim's point, if Jim and I can help alleviate those future difficult conversations for your plan participants in having a dialogue, getting them ready for retirement as early as possible, that's part of our goal. So it's personal responsibility on the plan participant, but there's also some responsibility designing the plan, making sure that the benefits, whether it's a matching contribution or profit sharing contribution or auto enrollment, putting a QACA together. There's a plan design issue as well. So actually we'll kind of talk about this. I think this is the most interesting part of the presentation, just talking about some of the plan design trends, figuring out what's been done in the past 2 years and kind of what the focus is moving forward. Jim, before you jump in, I always like those numbers on the right-hand side. Just talking about the changes over the past year, you start looking at the percentage increases on some of these topics, you really get a feel of the heartbeat of where the retirement plan world is headed, what topics are important, and kind of those key trends. So yeah, Jim, if you want to just jump into plan design changes made, we can kind of spend some time here.
Yeah, no, and I'd love to get your opinion. You're kind of on the front lines as well. I think the biggest thing that we've seen, kind of keeping with this theme of a very tight labor market, it seems like increasing matching contribution. I think a lot of companies were kind of battening down the hatches going into COVID. They realized they probably weathered it a lot better than they expected from that standpoint, kind of combined with a tight labor market. Increased matching contribution is kind of the biggest driver. Second biggest thing we've seen, and I'll just hit on a couple of these real quick and turn it back over to you, Keaton. Increased auto enrollment deferral rate. What we've seen is that the drop off, meaning the people who drop out of auto enrollment, stays the same from 3% essentially to 7%. It's up to 7%. So you can auto enroll an employee at 7%, and you really see very little change versus 3%. So what we've seen a lot of plan sponsors do is increase that number. Originally, it was 3% was kind of the norm. Now we're seeing it bump up to 6 or 7% with an auto increase higher than that. And then the last thing here that we're seeing a lot of is changing the matching formula, going from, depending on your setup and obviously what you're trying to accomplish with the plan, but stretch matching. So to get folks to save more to get to that 15% number, and kind of stretch matching, whether it's a 50 cents on the dollar or 25 cents, creative matching to make people, force them to save more to get the free money is it changes behavior. These are the things we're seeing really moving the needle from a employee readiness standpoint.
I would say 3 things, just based off of what you said in the slide. I guess first and foremost, that no change at the bottom, if you're not changing plan design or implementing new ideas or being proactive with your retirement plan, you're already behind the 8 ball, so to speak. There has to be some optimization in plan design. Again, the world is so different from 2.5 years ago with the formal shutdowns. There needs to be some optimization. I'd say 2 things, Jim, in addition to what you said specifically. Auto enrollment's been a kind of a key area to focus on. One of the things we do at Asset Strategy is we offload the responsibility of human resources, kind of working with plan participants regarding questions. So I talk to plan participants all the time. I can tell you that of all the plan participants that I talked to in the past year, 2 of them had a question about auto enrollment features, and none of those participants wanted to decrease the amount that they were contributing to the plan. So I'm getting questions about beneficiary designations, account balances, deferral percentages, options in the plan, what the target date is, kind of all these questions. Plan participants do not call us regarding auto enrollments. We just don't see it. So this big fear of plan sponsors saying, well, I don't think people are going to like that idea, and I don't want those phone calls or people knocking on my door. Number one, people knock on our doors, not yours. And number two, they're not upset about their automatic contributions to the retirement plan. So that's the first point I would say. One of the, I'd say, almost I wouldn't say plan design features, but one of the key changes we've noticed in the past 2 years, and this is the buzzword, but it's a buzzword for a reason, is financial wellness in the retirement plan space. Asset Strategy Consultants has done an excellent job of rolling out an education feature regarding financial wellness. We kind of have a suite of presentations that we work with our plan sponsors in order to help educate their employees. And here's what I mean specifically. We've talked about retirement readiness and kind of getting folks ready for that jump from accumulation to decumulation. We have put on seminars talking about Social Security, talking about college saving, HSAs, the basics of investing, debt management. And you would be amazed, and this is an employee benefit, by the way, you would be amazed at how many questions I get regarding around, the difference between a Roth and a traditional IRA, limits on an HSA, how do I actually figure out my Social Security benefit, what is a 529 plan, and what are the benefits? There are a lot of financial questions that just aren't being addressed. And by the way, financial literacy isn't taught in school. So there's this really big gap in the marketplace where this employee benefit of financial wellness has emerged, and plan participants love it. We were a little hesitant to kind of build this strategy out to help our plan sponsors because it was very time consuming to create this strategy. It's been a complete success. I'm very amazed at how, in addition to kind of all the services that we would do on the retirement plan side, using this as an extra service model, plan participants like it. Plan sponsors love it because they kind of offload all the responsibilities of teaching and educating, and they eliminate the phone calls and they eliminate the paperwork. And it's really become a pretty nice change over the past 2 years. Jim, really quick, just you want to touch on kind of the expected changes and hey, what's been done in the past 2 years, and hey, where's the marketplace going proactively?
Yeah, I'd say kind of I'd probably be reiterating what I kind of said to that standpoint. It is that kind of matching contribution kind of deferral rate. The other theme to kind of allude to what you're talking about is financial wellness has become a big thing and a big focus, especially through COVID and kind of people fairly stressed out about life and that sort of stuff. And I think you guys have studies and can share some of the statistics, but it's a tremendous form of stress, and offering those programs seem to be a tremendous benefit. We've seen unbelievable feedback from plan sponsors saying how financial wellness programs have really moved the needle for their organizations and for their employees, and seeing it as a big benefit. And getting back to our initial comments, it's a really tight labor market. We don't know what happens over the next 12 to 18 months, but we have to live in the present. And the response to financial wellness programs and what it's been able to drive from an employee satisfaction standpoint has really kind of blown us away and been off the charts from that standpoint. So I think that's what a lot of companies that don't have financial wellness, there's definitely a big focus on that and potentially offering that or rolling out those strategies because they've seen such a good response from it.
Yeah, I'm with you. I do like this slide though, just at the bottom, the no changes. We looked at the past 2 years, and then we're looking at expected plan design changes this year. So you kind of look at 2 years in the past and then in the present. Again, 12% of plan sponsors have not done anything, which means 88% of plan sponsors have. There's just a kind of a want. There has been a want to modify or optimize their plan design, and that trend's continuing in 2022 and beyond. So, briefly, I just want to talk about assets left in the plan. And just talking about kind of after employees retire, what's the preference? What does that look like? And kind of what strategies exist around these?
Yeah, I don't have a flag in the sand on this. So the real, to kind of just put this in just frame it for everybody on the call. It's okay. Jim's 65 years of age, retires from Fidelity or wherever Jim retires from. Does Jim roll his money out to an IRA? Does he leave it within his Fidelity corporate retirement plan? We're seeing interest in trends, especially in larger organizations, of folks leaving the money in plans. And what's driving that is a couple things. Plan economics to a certain extent, right? A lot of time your pricing in your plan is based on average account balance. And if all the older workers retire and pull their plan money out, your average account balance, just by the math of a large account balance being replaced by a new worker with no balance, it gets larger. So there's that element. From an employee standpoint, Keaton and team negotiate with the vendors and get unbelievable institutional pricing. So the investments that you have in your retirement plan right now with Asset Strategy or working with a consultant out there, you just have unbelievable pricing versus what Jim would get as a retail investor off the street. So that's kind of potentially could drive it to a certain extent. And you are seeing some innovation in regards to income and that sort of stuff. That's one side of the equation. The other side of the equation is for smaller employers, they're like, gosh, I want to get this money out of the plan because it's a logistical headache and I don't want this responsibility. If somebody moves, tracking down notices, all the stuff that you have to deal with. From an employee standpoint, the other side of the ledger board is like, okay, I'm done with my company. I'm ready to move my money on to somewhere else. And some of these plans don't have a clean, slick way of pulling money out of the plan. They may charge you, they may cut checks and charge you for the checks and that sort of stuff. This is a trend that it remains to be seen what kind of happens. I think a lot of the retirement plan providers are saying, okay, we could see a lot more assets remaining in the plan. Where it stands right now, I think if someone has some meaningful assets in the plan, a few $100,000, they retire. Typically right now, the majority of those folks will work with a financial advisor for more one-on-one customized solution. But maybe those folks who fall below that threshold of having that one-on-one financial advisor advice, maybe someone with a smaller account balance, maybe staying in plan is not the worst solution because they've got really good pricing on that account. Maybe they're in an investment product that can kind of de-risk through retirement. So who knows on this? I don't know which way it goes, but we're seeing some trends of maybe some more money staying in plan longer, whereas kind of the norm was pull it out as soon as possible.
Well, that's right. We like the slide just to illustrate kind of what options exist. I think you hit the nail on the head, Jim. One of the projects we worked on in Q1 of this year at Asset Strategy is better understanding fees that exist in plan and out of plan. So there's some legislation that was passed. It's called the Prohibited Transaction Exclusion Rule. And essentially what we had to do as financial advisors is understand what the process was, particularly regarding fees in plan and out of plan. So to Jim's point, if you're looking to move your investments out of the plan of retirement, what does that actually look like in real costs? And we're finding out that there's options that exist inside and leaving the assets in the plan that might be beneficial for some participants, and there might be some some advantages of moving money outside of the plan. But the point of this slide is just to let plan sponsors know, and then in turn, when we talk to plan participants, there are multiple options when you retire. You don't hit the finish line and then all of a sudden it's game over. You take your lump sum of money and that's it. There is a lot of strategy and nuance regarding individual situations and what works best for different types of people. So I'll talk about that here at the very tail end of the presentation coming up. But one of the things that we wanted to take a look at is just impending trends. There are, as you're finding out, there are a lot of trends and goals and things to discover moving forward with retirement plans in 2022 and 23. But one of the things that we are really strong on is ESG investing, environmental, social, and governance, or impact or green investing. We've done a tremendous job at Asset Strategy Consultants, focusing on negative screening of investments. And I'll kind of give you an example. I actually did a presentation last quarter about this. We have a lot of plan sponsors or their investment policy statements, or plan participants come up to us and say, hey, Keaton, I feel passionately about fossil fuels. I feel passionately about gender equality in the workplace. I feel passionately about weapons of war or deforestation or some really key issues. And the follow-up question is, do we have any of those investments in the plan? And what we try to do as independent advisors is educate. And what we've been able to accomplish is we've created a study for all of these topics, and we are able to tell you in underlying funds whether or not there are fossil fuel companies in the plan, if there's a plan sponsor who cares about that, if there are weapons of war manufacturers or gun manufacturers or wholesalers, we can give you a nice breakdown of gender equality, the gender equality and kind of the social side and governance side of companies, board structure, opportunities for advancement. Are there transparent ways to report of something going on in the human resources space? So we've done a really good job of building out this kind of unique tailored report for our plan sponsors that actually want some transparency in that space. So I know I kind of jumped ahead here, Jim, but
no, I think
we're pretty passionate about helping people understand their exposure.
Yeah, no, I think this is going to be, and Fidelity believes this is going to be a big focus going forward. If we look at Europe, this is almost like default doing the stuff that you folks are doing here. It's much more cutting edge from that standpoint. I'd say us as an organization as well, we offer a women's leadership product, a water fund. We have kind of impact investing stuff and then also stuff that screens out. But what I would say, even in our normal mutual investment funds, we have a whole ESG analyst team now, which is actually doing due diligence on, to your point, board governance, social issues, human quality, diversity and inclusion in the workplace. And our portfolio managers, it may not be an ESG fund, but they're oftentimes looking at that sort of stuff, because what you find is it could be very valuable to the company's performance and the stock performance over time, meaning companies that kind of have these ESG functionalities, those stocks tend to perform better oftentimes over time. So it's another tool we use in our arsenal, not just when we offer pure ESG, but it's becoming more the norm that other investment managers, asset managers are starting to have this as one of the tools in a portfolio manager's toolkit when they're selecting the underlying stocks and bonds in the portfolio.
Yeah, I would just add a note here. This isn't a pro or con ESG conversation, but what it is, in our opinion, is it is a way for plan sponsors to help better educate themselves regarding what investments are actually in the plan. Most mutual funds have tens or hundreds of holdings in them, and our job is to educate, right, and bring that information to an investment committee, or to the CFO or to the director of HR, and help them understand where their money is actually going. So pressing on, I did talk about financial wellness programs making an impact. Again, in our experience at Asset Strategy Consultants, this has been the big key area outside of kind of our normal work that we do for plan sponsors. This is the area that people seem to latch on to. Jim, this is a Fidelity slide. I don't know if you had one or two comments on this, or if we can press forward.
Yeah, no, I just think like it's been impactful. I think like the folks who've implemented really like it, and it's been meaningful, and it's win-win, and the employees really enjoy it as well. And I think it's potentially the right thing to do for employees, but it also creates a happier workforce, which is hopefully a more efficient workforce as well.
Yeah, I always make the joke that you can either have a structure for financial wellness, or you could just keep listening to your broke brother-in-law. And we find that plan sponsors really like a formalized plan in order to help their employees. Would you just touch on HSAs? There seems to be a lot of buzz around HSAs versus 401ks, and kind of figuring out what that conversation looks like and marrying those strategies over time.
Yeah, kind of really big picture. HSAs, obviously health savings accounts. If you have a high deductible plan, you can offer in tandem with that a health savings account, which allows employees to save in that account, to save for retirement. We've seen more employers kind of move towards high deductible plans, and think we're going to see that trend to continue. Just the stuff with the Cadillac tax and stuff, probably everybody's pretty familiar with. So we see a movement in that direction. Historically, HSAs that market was controlled by the banks, right? So the healthcare company would team up with a bank, and they would offer you a debit card, and you'd swipe the debit card at CVS or at the doctor's office. We're seeing a transition in thinking, where it's not, hey, I need to burn my money through the year. I've got all this money in here. Let's go to the CVS and buy this and that and load up on this and that and qualify purchases. We're seeing a shifting in thinking in which folks are starting to view the HSA as more of a long-term retirement savings vehicle. If you think about your retirement expenses, net of home and shelter, healthcare is going to be number 2. And we put out a lot of studies on that. I know it's challenging at times, especially if you have small children or kids. But what we're seeing a lot of folks is start to view this as more of a long-term savings vehicle, where they're viewing it as more as another element of their 401k or their retirement savings plan, and trying to kind of grow those assets over time. And the beautiful benefit of this thing is it's unbelievable. And I had to hear it a couple times before it really sunk in, is it's triple tax free. So you put it in tax free, it grows tax free, and you take it out tax free. There are very few things in this world, maybe nothing in the world like that. And again, we don't see most people we see are kind of in the middle. We have a small population that does not touch this. So kind of think people who just want to save this over time. We also have a smaller population who spends every nickel every single year. Most of the folks kind of fall in the middle, which some years they don't really touch it and they let it to grow. They have to dip it into it here or there. But the view that you can let this thing grow over time if you can, and it could be an unbelievable tool for you in retirement to pull money out tax-free for your healthcare expenses in retirement.
There's a lot of strategy that goes into HSAs and financial planning. I would say if you have not reviewed your HSA strategy with your organization, that's absolutely something asset strategy consultants can work with. We do a lot of comparative reviews. We do RFPs and RFIs on that. And Jim, you're right. It really did start at the bank level. In fact, my first HSA was with a bank, and I just look at what I'm doing now on the strategic side versus what I had when I kind of first started my career. It's vastly different. So I would just say there's a nice value add talking about strategy of HSAs in concert with their benefit package, with your benefit package in your 401k or 403b. A few slides left here as we get to the top of the hour. Jim, you just make a note here on some of the investment changes that you're seeing on the menu and some of the popularity of these top results.
Yeah, I'll pick one of these, which always jumps out at me. If we look at the number one result, it's the number one decision people have made is increase the number of investment options at its plans. If you take that data and you look at the largest plans in the marketplace, over $500 million, in the last 10 years, the number of investments options that they have offered on average has gone from 25, including target date as one option, to 15. So 25 to 15. So arguably the smartest, most sophisticated committees, advisors, consultants are seeing the value in reducing the number of investment options, having one or two international, one or two bond funds, kind of core equity. Unfortunately, what we're seeing for the majority is this investment creep. And what happens is, oh my God, inflation's really high. We need to add something for inflation. And then next quarter it's something else, and next quarter something else. We could share with you a million studies. The more investment options that you have, the more confused people get, the less likely they are to save for retirement. So just don't do it would be my kind. Well, I mean, really evaluate before you let the menu continue to creep up.
I think that's right. This goes back to what we spoke about earlier at the beginning of this presentation. For plan sponsors that haven't revisited their fund menu and are still floating around that 25, 30, number of funds available to the plan, it's really time to reevaluate options and maybe make a more concise menu or enhance the menu. We've looked at plans from prospects that the funds haven't been updated in 10 years, which I think is probably a dereliction of duty as a fiduciary, but neither here nor there. Point being is the investment options available to the plan needs to be regularly visited. And if you haven't done that since pre-COVID time, I think the opportunity is now. Last topic is retirement income. This is an illustration of what Jim and I have been talking about the entire conversation. What our job is to really focus on the accumulation phase through education. We see that danger zone as people approach that retirement date. We want to help people understand that there is a process, a strategy, in a nuanced way to access their money in the decumulation phase. It's very bizarre to plan, save, budget, and invest your entire life, and then all of a sudden you hit the brakes, and now you need to start withdrawing income. There are a lot of ways to do that. One of the ways that we've seen is to really break out needs and wants in retirement through some financial planning strategies that we have. And our goal, without diving too deeply into it, is understanding what options are available for income in retirement, whether it's Social Security, a pension, or some type of annuity or guaranteed income product. We're really focused on portfolio structure and building that out for our clients. At any rate, there are some good guaranteed products that exist within retirement plans. We're very strong on this topic and are more than happy to sit down with plan sponsors regarding these options, whether it's a guaranteed minimum withdrawal benefit or talking about how to marry a strategy like this with Social Security. But really what we'd like to do is focus on retirement plan design, both for employees during retirement and after retirement. That really helps with recruiting, retention, and then really satisfies their retirement requirements. Kind of in their golden years. And there are a lot of advantages that we did talk about, whether that's not extending the retirement date for plan participants, reducing financial stress on employees. But just rest assured that Asset Strategy Consultants is a resource in the retirement income space, and we are here to help optimize plan design as time marches on. I think with that, we're at the top of the hour. I appreciate everyone taking some time out of their lunch break to join Jim and I on some of the trends that are happening in the retirement plan space. As a follow-up, please reach out to our team at Asset Strategy Consultants. We are more than happy to sit down with you to help you optimize your plan, modernize your plan, and help you as an ally moving forward in time. Jim, thank you so much for your time this afternoon.
Thank you so much for having me, and thanks for everybody for joining us. Have a great rest of the day.
Thank you, everyone.
See ya.